There have been many different theories about economics and how changes in government policy can alter the economic growth of a country or even just a region. One theory that comes up fairly frequently is trickle-down economics. What actually is it? How's it supposed to work? And is it really effective? We'll start with, though it's often called trickle-down economics, the proponents of the theory prefer to call it supply-side economics. The first pillar of the theory is that by setting a median level of taxation, you can actually maximize the tax revenue for the government. So if you were to set the tax levels to a ridiculously high level, businesses and individuals get to keep such a small proportion of the wealth they generate, they lack any incentive to work hard or invest in the future, so they know the government is going to take nearly everything that they produce. Again, however, if you set the tax rate at a ridiculously low level, now people are working hard because they get to keep a large percentage of their earnings, but because the tax rate is so low that even though economic activity is high, again, government income is low. The idea is that you can set the tax levels low enough so that people and businesses work hard and efficiently, yet high enough that you maximise the income for the government. The problem here is that setting the ideal tax rate varies with a great many other factors, including the type of tax being collected, economic activity, international tax rates, interest rates, etc. However, tax authorities in most major economies will be able to inform politicians of which tax rate at which particular time will generate the maximum amount of revenue for the government. Now, the novel part of supply-side economics is how it can be used to stimulate growth in the economy. Traditional Keynesian economics says that you cut government spending during periods of high growth and pay off the debt, partially to prevent an unsustainable boom, and partially so that during a recession you have extra capital the government can spend to minimise the impacts of a recession. Supply-side economics has another way to stimulate growth. Instead of increasing government spending, what governments could do is reduce the higher rates of personal taxation along with the higher rates of corporation tax. With corporation tax lower, companies will make more profits, be incentivized to invest the additional profits back into the business, thereby increasing jobs, reducing the impact of a recession. Cuts in taxes for the low and middle income earners, according to the theory, don't actually have much of an impact on the recession, as these people have very little discretionary spending, and any extra income received as a tax cut is likely to be spent paying off either credit card debt or mortgage payments. However, those on higher incomes do actually have significant levels of discretionary spending. Reductions in their income tax will mean that they can increase their levels of spending. These additional purchases will then stimulate the economy and increase jobs and wages, reduce the impact of recession. Hence, a tax cut to the wealthy will trickle down to the other levels of society in the form of more jobs and increases in wages. The benefit of this approach is that the tax cuts, actually because they increase economic activity, only actually have a marginal impact on government income. So the government doesn't have to substantially increase borrowing as a result. So, that's at least a theory. However, we do run into problems. Cuts in corporation taxes during a recession don't lead to an increase in investment, as companies uncertain about the future will only invest the additional money once they have a more certain view about the future for themselves. The additional cash will be used to pay off debt or kept in the bank in case of future problems. The wealthy individuals, though, are actually fairly likely to spend the additional money. This spending is likely to be on high-value goods which actually require only a few people to be employed in making them, or, alternatively, are actually imported from outside of the country, again meaning that these tax cuts have little or no impact on the depth of a recession. So whilst avoiding punitive levels of taxation will maximise government income, trickle-down economics as a method of stimulating growth is just a failure, I'm afraid.